Welcome to Y News, I am Christopher. Recently, the Federal Reserve made its decision to raise interest rates for the 10th time in nearly 14 months, causing a market shock. The continued rate hike not only brings the US itself closer to recession, but also makes the world pay for it together. Europe, one of the regions most affected by the US, followed the US lead and made its seventh passive rate hike since last July. According to Yahoo News, the ECB decided to raise all three key interest rates in the eurozone by 25 basis points at its monetary policy meeting on May 4, making the main refinancing rate, marginal borrowing rate and deposit facility rate increase to 3.75%, 4% and 3.25% respectively from the 10th of this month. However, analysts believe that tight monetary policy has led to continued weakness in the eurozone economy. The European Central Bank faces a dilemma between resisting inflation and seeking economic growth. Due to the role of the dollar hegemony, the Fed's aggressive interest rate hikes this round of US bond yields rise, the dollar quickly strengthened, its spillover effect induced a massive flow of funds to the United States, so that many countries' stock markets, currency markets and bond markets suffered a violent impact, forcing these countries to follow the interest rate hikes in order to maintain macroeconomic stability, thereby increasing the risk of recession in their own economies. Globally, most central banks are raising interest rates to the same degree of synchronization as they have in 50 years. According to the analysis of World Bank experts, the rise in US interest rates over the past year was mainly a reaction shock, driven by investors' expectations of a shift to a tougher monetary policy stance by the Federal Reserve. This reaction shock, driven by the rise in US interest rates, is particularly harmful to the financial markets of emerging markets and developing economies. The sharp rise in US interest rates, and the corresponding rise in the foreign exchange value of the US dollar, has proven to have significant spillover effects on the cost of borrowing in emerging markets and developing economies. Debt levels in many emerging market and developing economies have generally soared, with government debt reaching record highs in many countries, and some countries have fallen into financial distress and even defaulted on their debts. The Debt Relief for a Green and Inclusive Recovery (DRGR) report, jointly released in April by the Center for Global Development Policy Studies at Boston University, the Center for Sustainable Finance at the School of Oriental and African Studies at the University of London, and the Heinrich Böll Foundation, shows that sovereign debt in emerging markets and developing economies increased by 178% between 2008 and 2021, from $1.4 trillion to $3.9 trillion. The U.S. Consumer News and Business Channel also warned that the Federal Reserve's interest rate hikes will exacerbate the global debt crisis. According to the U.S. Treasury Department, debt payments for developing countries increased by 120% between 2010 and 2021, reaching the highest level since 2001. The average percentage of government revenue spent on external debt payments increases from 6.8% in 2010 to 14.3% in 2021. IMF chief Georgieva has warned that the Fed's interest rate hike could throw cold water on the already difficult recovery in some countries. The rise in U.S. interest rates and the appreciation of the dollar could make it more expensive for countries to repay their dollar-denominated debt. By the end of 2022, the total debt of developing countries rose to a record $98 trillion. Bloomberg information columnist Eduardo Porter recently posted an article questioning, can the Federal Reserve under Powell afford to ignore the costs generated by geopolitics? The article points out that now the Fed is once again facing the hyperinflation of the Volcker era. As the Fed is raising interest rates at the fastest pace in more than 40 years, the raw memories of dashed hopes for economic prosperity are resurfacing across Latin America and in developing countries more broadly. In connection with the direct and indirect harm caused to many countries over the years by the U.S. using the U.S. dollar hegemony to impose indiscriminate unilateral sanctions on others, the international community generally believes that the U.S. economic and financial policies have become the greatest challenge to global financial stability, economic recovery, and common development. In the face of the hegemony of the U.S. dollar on the world economy, more and more economies began to take practical action to defend their rights and interests. Many countries, including some U.S. allies, have actively explored the path of de-dollarization by reducing their U.S. debt holdings, promoting bilateral currency agreements and diversifying foreign exchange reserve assets. In addition, central banks are also buying gold at the fastest rate since 1967. Reuters reports that central banks purchased a record 1,136 tons of gold in 2022, and the global trend of central bank gold purchases continues in 2023. As the global de-dollarization process accelerates, the dollar's grip on the international economic system as the world's reserve currency is weakening. Data show that over the past 20 years, the dollar's share of the world's central bank's international reserves has fallen by 12 percentage points, shrinking from 71% to 58.36% in 2022, the lowest level since data were recorded in 1995. Peter Earle, an economist at the American Institute for Economic Research, pointed out in his article, De-dollarization, that the US dollar has gradually turned from an ordinary payment, settlement and investment vehicle into a financial tool used by the US government to impose unilateral sanctions, especially after the escalation of the Ukraine crisis last year. The US has recklessly the practice of weaponization has accelerated the flight of many countries. In the long run, de-dollarization will continue, and the dollar will lose its power overseas either sooner or later.